Good day, sir. My name is Yoshni Anapapavijanan. My matrix number is 01D8323F2012. So today for our case study, I'm going to talk about the definition and objective. First of all, we have lease, a contract or a part of a contract that conveys the right to use an asset, the underlying asset, for a period of time in exchange for consideration. This means that a lease exists when one party, the lessor, provide another party, the lessee, the right to control and use a specific asset for an agreed period in return for payment. Second, we have a right of use asset, an asset that represents a lessee's right to use an underlying asset for a lease term. Third, we have lessee, an entity that obtains the right to use an underlying asset for a period of time in exchange for consideration. Fourth, we have lease term, the non-cancelable period for which a lessee has the right to use an underlying asset. Together with A, we have periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option. B, we have periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise the option. Fifth, we have lessor, an entity that provides the right to use an underlying asset for a period of time in exchange for consideration. We have lease payment. So lease payment are basically payments made by the lessee to a lessor relating to the right to use an underlying asset during the lease term. This payment includes fixed payments, which is including subsistent fixed payments, less any lease incentive, variable leases, payment that depends on an index or rate. We have the exercise price of a purchase option if the lessee is reasonably certain to exercise it. And last but not least, we have penalties for terminating the lease if the lease term reflects the lessee exercising such an option. Thank you. So now we're going to talk about the objective. This standard sets out the principle for recognition, measurement, presentation, and disclosure of lease. The objective is to ensure that lessee and lessor provides relevant information in a manner that faithfully represent those transactions. Other than that, an entity shall consider the terms and conditions of contracts and all relevant fact and circumstance when applying this standard. An entity shall apply this standard constantly to attracts with similar characters and in similar circumstance. Thank you.
Good morning to our lecturer Anji Ahmad Sanari. Today I am Sandhya Ganesan. My matrix number is 01D8323F2004 from team 7 are going to discuss about the MFRS 16 for the topic leases. So let me start with the recognition process for both lessee and lessor at the commencement of the lease. First, let us look at recognition for the lessee. At the commencement date of the lease, the lessee must recognize two things. First would be the right of use asset. This represents the lessee's right to use the lease asset over the lease term. Second would be the lease liability. This is the present value of future lease payment that the lessee is obligated to make over the lease term. The recognition of both the right of use asset and the lease liability ensures that the lessee's financial position reflect their lease obligation appropriately. Now, let's look at the recognition for the lessor. At the same commencement date, the lessor must classify the lease in one of two ways, which is finance lease or operating lease. Finance lease, if the lease transfers substantially all the risk and rewards of ownership of the asset to the lease, the lessor must classify the lease as a finance lease. If the lease does not transfer substantially all the risks and rewards of ownership, it is classified as an operating lease. This classification of the lease will affect how the lessor recognizes income and expense in their financial statement. Next, let's look at the measurement for lessee. ROU asset, the right of use asset. At the commencement date, the lessee measures the right of use asset or ROU asset at cost. The cost of right of use asset includes first the amount of initial measurement of the lease liability. Second, lease payment made before or after the commencement date minus any lease incentive received. Third would be the initial direct cost incurred by the lessee, for example, legal fees. And finally, any estimated cost for dismantling or restoring the underlying asset or site it required by the lease term. In short, the right of use asset represents the lessee's right to use the lease asset, measured based on all relevant costs at the start of the lease. Second, lease liability. Next is the lease liability. At the commencement date, the lessee measures the lease liability at the present value of lease payment that not had been paid. These payments are discounted using the interest rate implicit in the lease, or if that can't be easily determined, the lessee may use incremental borrowing rate. The lease payment include first fixed payment less any lease incentive receivable, variable payments depending on an index or rate, amount expected to be payable under residual value guarantee, exercise price of purchase option if the lessee is reasonably certain to exercise it, and penalties for terminating the lease early if applicable. Third would be the subsequent measurement. After the commencement date, both the ROU asset and the lease liability need to be updated over time. For the right of use asset, it's measured at cost, less accumulated depreciation, any impairment losses, and adjusted for any remeasurement of the lease liability. The lease then applies under the usual depreciation rules under MFRS 116. For the lease liability, the carrying amount is increased by interest on the lease liability reduced by lease payments made. It's also remeasured for any reassessment or lease modification. Number 4 will be other models of measurement. In some cases, if the lessee applies the fair value model under MFRS 140 for investment property, they must also apply the fair value model to the ROU asset. In other words, similarly, if the ROU asset relates to a class of property measured under the revaluation model in MFRS 116, the lessee may choose to apply that model as well. So here, the measurement basis for the ROU asset depends on how the related class asset is treated under the relevant accounting standard. So now, let me explain about the measurement for lessor, which is divided into two types: finance lease and operating lease. Finance lease. In this type, the lessor uses the interest rate implicit in the lease to measure the net investment in the lease. If it's sublease and the rate cannot be easily determined, the intermediate lessor may use the discount rate used for the head lease instead. The initial direct costs are included in the measurement, and these costs reduce the amount of income recognized over lease term. At the commencement date, the lease payment should include fixed payment, including substance fixed payment minus any incentive, variable payment depend on index or rate, residual value guarantee by lease or third party, exercise price of purchase option if it's reasonably certain to be used, and last would be penalty payment if the lessee ends the lease early. So overall, a finance lease, the lessor basically record the lease as a financial investment rather than asset. Operating lease. Now for the operating lease, here the lessor recognize the lease payment as income, either on straight-line basis or any other systematic basis that better reflect how the asset benefits are used up. Costs like depreciation and expenses are recognized as they occur. The lessor also adds any initial direct cost to the carrying amount of the lease asset. Depreciation follows MFRS 116 and 138 depending whether underlying asset is tangible or intangible. The lessor must also check if the asset is impaired. For manufacturer or dealer lessor, there is no selling profit recognized in operating lease because it's not considered sale. Lease modification. If there any modification to the lease, lessor must treat it as new lease from the effective date of change. Also, any prepay or accrue lease payment from the lease are included in the new lease payments.
Hello everyone, my name is Janani Nyanasundram and my metric number is 0 on Dpa30053F2020. Today, I will explain about presentation and disclosure under MFRS 16 leases. Let's start with presentation for lessee. First, in the statement of financial position, a lessee must show right of use assets separately from other assets. If they are not shown separately, the lessee must clearly disclose which line items include these assets. Next, lease liabilities should also be shown separately from other liabilities. If not, the lessee must mention which line items include those liabilities. However, this rule does not apply to right of use assets that are investment properties. In the statement of profit or loss, a lessee must show the interest expense on lease liability separately from the depreciation charge on the right of use asset. The interest expense is recorded under finance cost. In the statement of cash flows, the lessee must show three things. Firstly, cash payment for the principal portion of the lease liability. Secondly, cash payment for the interest portion of the lease liability. Thirdly, payments for short-term leases, low-value assets, and variable lease payments. Now we are going to look at the presentation for lessor. For the lessor, the rule is simple. They must show underlying assets that are under operating leases according to the nature of the asset in the statement of financial position. Now, let's move on to disclosure. Firstly, I'm going to start with the disclosure for lessee. The objective based on paragraph 51 is to help users understand how leases affect the lessee's financial position, performance, and cash flows. According to paragraph 52, all lease information should be disclosed in one note or a separate section of financial statements. In paragraph 54 to 55, it is suggested that information is shown in a table format and leases must also show lease commitments for short-term leases. Paragraph 53 explains the amounts to disclose. Leases must show depreciation of right of use assets, interest expense on lease liabilities, expenses for short-term and low-value leases, income from subleasing, total lease cash outflows, and lastly, addition to right of use assets and the closing carrying amounts by asset class. Under paragraph 56 and 57, if right of use assets are investment properties, follow MFRS 140. If revalued, follow MFRS 116. Paragraph 58 requires leases to show a maturity analysis of lease liabilities as stated in MFRS 7 and it must be shown separately from other financial liabilities. Now we are going to look at the disclosure for lessor. For the lessor, the objective under paragraph 89 is to give information that help users assess how leases affect the lessor's financial position, performance, and cash flows. According to paragraph 90, the lessor must disclose two things. Firstly, for finance leases. Under this, we have three things. First is selling profit or loss. Secondly, finance income from the net investment. And thirdly, income from variable lease payment. According to paragraph 90, the lessor must also disclose four operating leases. This shows lease income including income from variable payments. In paragraph 91, this disclosure should be presented in tabular form. unless another format fits better. For finance leases, paragraph 93 to 94, the lessor must explain any changes in net investment and show a maturity analysis of lease payments for at least the first 5 years and the total for the remaining years. For operating leases, paragraph 95 to 97, the lessor must apply MFRS 116 for property, plant, and equipment, and the lessor must also separate leased assets and owned assets. And lastly, the lessor also have to show undiscounted lease payments receivable for at least 5 years. In conclusion, the presentation and disclosure part of MFRS 16 is very important because it helps users clearly understand how leases affect both lessees and lessors. It ensures transparency, accuracy, and better decision making in financial reporting. Now, let's look at the appendix part, which shows a real example from Sime Darby Berhad annual report for the financial year ended 30 June 2024. This example shows how the company applies MFRS 16 leases in its financial statements. Firstly, in the statement of financial position, under non-current assets, we can see right-of-use assets, which are shown in Note 22. For the group, the amount in 2024 is 3,372 million compared to 2,669 million in 2023. For the company, the amount is 1 million in 2024 and nil in 2023. This shows that Sime Darby recognized right-of-use assets according to MFRS 16, which represent the company's right to use leased assets. Next, under non-current liabilities, we can see lease liabilities shown in Note 41. For the group, the amount in 2024 is 2,231 million and in 2023 it was 2,162 million. For the company, the amount is 1 million in 2024 and nil in 2023. These lease liabilities represent the company's obligation to make lease payments in the future. Lastly, in the statement of cash flows, under cash flows from investing activities, we can see right-of-use assets listed. For the group, the amount in 2024 is nil and in 2023 it was 227 million. For the company, the amount is nil for both years. This shows the cash flow related to acquisition of right-of-use assets under lease agreements. In conclusion, this example from Sime Darby Berhad shows how MFRS 16 leases is applied in real financial statements, where the right-of-use assets and lease liabilities are clearly presented and disclosed according to standards requirements. So, that's all from me. Thank you for listening.